I want to try to string together a few questions and see if you can talk a little bit about what attracted you initially to investing globally and investing in emerging markets. And then if you could just share what is different about investing in emerging markets and what the experience is like. And we'll get into in a second, you have amazing stories of obviously some, key moments in time, but just at a high level, talk about that.
Sure. So more nuances than perhaps I anticipated, and so there's been a lot of learning lessons along the way. I think, I think two main factors stand out. One, the way that these international and emerging markets value capital markets in terms of litmus tests of the economy's health, or here in the U.S. where we have presidential elections where the presidents are lauding the stock market's performance as some measurement of success. That really isn't always the case in emerging markets. I think there you encounter much more populism, much more fiscalism. Obviously, corruption is much higher, and so in some ways, the risks of impairment and drawdowns are greater, and that's sort of an element of how we manage money is being more attuned to those risks and understanding the need to sidestep those altogether. I think relatedly, macro investing. I mean, as I mentioned, we felt like macro investing was paramount in trying to navigate emerging markets, but also we could see these trends globally, which is why we really enhanced our macro capabilities, including adding one of the portfolio managers over a decade ago. But understanding how macro policy impacts bottom-up fundamentals, risk premia, is really important. And I think if you look at arguably what has been the largest driver of asset returns in the U.S. over the past decade, this kind of exorbitant privilege that people talk about with the U.S. dollar and what that enables the Federal Reserve and our policymakers to do in terms of buffering and stabilizing asset prices. The emerging markets generally are not equipped with similar capabilities. So countries like Turkey or like Brazil would like to cut interest rates aggressively and drive up asset prices, but the reality is that the release valves in emerging markets there's far more pressure built up beneath those, at least for the time being. So what we see is Turkish equities rally, but the currency depreciates by 30 or 40% over the same time, or sovereign debt rates explode higher, whereas a country like the U.S. has been able thus far to sort of circumvent that. So I think those are crucial. I think similarly, understanding who's sort of on sides with various government entities. It's not universal, but in a majority of those markets, it's important to understand which companies are sort of on sides with the prevailing government as opposed to the opposition government, and that additionally is complex as well. So I think those elements really do stand out. I think the growth. There's a growth dynamic which does differentiate emerging markets. I think you have to keep in mind that, again, somewhat differentiated from the United States, when countries grow, there does come sort of precipice where too much growth or too much success can place you onto the government's radar, and oftentimes it's more innocent in terms of, hey, taxation will go up, or you need to do a bit more to contribute to the social well-being of the country. In other instances, like we saw last year with the Chinese tutoring companies, it can be something altogether more detrimental.